Hi everyone. So welcome to the live stream today. Really excited for having you on the stream today as we continue with our IFRS masterclass. My goal on the lecture today is to solve some ICAG past questions with you and looking at how the questions are going to be the questions are going to be set, and then also taking us through the various principles that we have been learning all this while when it comes to dealing with the accounting standards. So we've covered a couple of the accounting standards already. You can check the podcast session on the YouTube channel, and you'll be able to look at the IFRS masterclass and look at all the lectures that we have covered under the IFRS. So, what we are doing today is to start trying to now solve practical questions and see how these principles apply and how we can use them in a given question or in a given scenario. See some of you guys joining, you are welcome. Give us a thumbs up on the video, it really helps us a lot. And also remember to share the video. Let's reach as many students as possible. So share with your colleagues and the people, your groups where people must learn financial reporting and corporate reporting. Let's together help a lot of students to really pass the examination. So I want to also hear from you if there are any questions you have for me in respect of financial reporting, corporate reporting, the accounting standards. Don't hesitate. Put it in the comment section for me or the chat box. I'm going to be reading all your comments and also providing you with some assistance as we get ourselves excited into the lecture today. Right. So let's get straight up into the discussion, and then let's go in there and begin to solve some questions quickly as we try to apply the various principles that we have been learning so far. So today we want to start a discussion with the ICA Financial Reporting July 2022 examination, and we're going to be focusing on question 2, where we're going to see a lot of the accounting standards at play, and we want to see how the accounting standards are going to be applying in various circumstances. So what I'm going to be doing is to read a question, then as we answer the question, we do a quick revision of the principles so that you see how the various principles actually apply at the end of the day. So let's go straight up. July 2023 ICAG. You can download the question on the ICAG website. So we want to go into it and see some questions. So question 2, that is where we're going to be at largely today, and see a couple of treatments that we need to look out for. Couple of standards that will be coming up here will be IAS 16, property, plant and equipment, IAS 36, impairment of assets. We're going to be sharing some thoughts also on IAS 20, government grants, looking at the issue about IAS 37, provisions, contingent liabilities and contingent assets. And these are all non-current assets related accounting standards that will be featuring, whether I like it or not, in the exam hall one way or the other. So we are using this as a guinea pig to really walk us through the principles and see how we can apply the principles in a given question. So let's go straight up. Question 2, we're looking at the A aspect of the question first. So question 2A. For 5 marks, the examiner is asking students, assuming Manyabi Limited represents a cash generating unit, show the financial reporting treatment of the brand name at 31st December 2021 in the books of Bondito Limited following the impairment review. So 2 words are here: cash generating unit. Now, what is a cash generating unit? It means that IAS 36 is coming to town, impairment of assets. Then there is another word that the examiner has said, following the impairment review. That is a second phrase that will help us to understand exactly what is going on. So we are doing impairment testing in this case, and then to find out how we can deal with it generally. Now, if you remember, in accordance with IAS 36, impairment of assets, we say that a cash generating unit, which is a group of assets which can independently or which can together generate a lot of assets on their own, or a lot of revenue on their own together. When we look at a cash, give me a sec. Okay, let's go. So a cash generating unit is simply, a group of assets that together generate economic benefits for the entity. So a cash generating unit is said to have suffered an impairment when the carrying amount exceeds the recoverable amount. So when our carrying amount, that is the amount at which we are carrying the asset in our books, it's greater than the recoverable amount of the cash generating unit, then we say that the asset has suffered an impairment. But the question we ask ourselves is, how do we get the recoverable amount of an asset? Pretty simple. The recoverable amount of an asset is simply the higher of the value in use and then fair value less cost to sell. You know these already. We've spoken about these, so just doing a quick revision to let you understand what is going on. Now, once we have identified that there is an impairment loss, yes, we're going to be debiting our profit or loss because it's an expenses. So we debit profit or loss. And then we're going to be crediting the assets generally. But it is important that if we are dealing with a cash generating unit, then the amount of impairment will not be allocated to just one asset, but instead it's going to be allocated to group of assets. So then it is very important we know how to allocate impairment when it comes to dealing with a cash generating unit. The rule is that we will first, write off separately identified impaired assets. Okay, separately identified impaired assets. That's the first thing. Then, after that, if there is goodwill, we write off goodwill because it's a cash generating unit. We write off goodwill. Then, after that, we're going to be allocating the remainder, if there is any, between the other assets. Okay, between the other assets on a pro rata basis. Okay, on a pro rata basis. So when it comes to testing of impairment and allocating of impairment for a cash generating unit, this is how we dance. This is how we go about it in that particular case. So the rule is once the carrying amount exceeds the recoverable amount, there is an impairment. And so we debit profit or loss, and then we have to credit the asset. But it's a cash generating unit, so you cannot credit just one asset. So you need to allocate it. And this is how we do the allocation. So this is the principle that must come in your mind immediately you read this 5-mark question that, hey, assuming Menyabi Limited represents a cash generating unit, show the financial reporting treatment of the brand name as at 31st December 2021 in the books of Bondito Limited following the impairment review. Okay, following the impairment review. So let's go and see what we could have here. Bonito Limited acquired 100% of a subsidiary, Menyabi Limited, on 1st January 2021. So stay with me. The date of acquisition is 1st January 2021. Our reporting date is 31st December 2021. Now, like I say always, it is important you understand these years because possibly it could affect the way we calculate impairment, depreciation, and other things. The carrying amount of the assets of Menyabi Limited in the consolidated financial statement of Bonito Group at 31st December 2021, immediately before an impairment review. Again, immediately before an impairment review is 11.8 million Ghana cedis. So we have goodwill, we have brand name, da. But you got to be careful because current account, it says they are at recoverable amount. Because if you remember, when we are dealing with allocation of impairment, cash and trade receivable, those things are usually stated at their recoverable amount. So we wouldn't allocate impairment to these items. Okay, usually they are at their recoverable amount, so no allocation of impairment. But let's continue. The recoverable amount of Menyabi Limited was estimated at 9.6 million at 31st December 2021. So we done. So let's go back and then let's do the workflow. So Menyabi Limited. So the way we're going to present this is, in a very succinct manner. 1, 2, 3, 4. So I'm going to have the assets here. Then I'm going to have the carrying amount here. Then I'm going to have the recoverable amount here. Okay, so that I will have impairment in the middle. Presentation is important, so I'm going to have impairment in the middle. So 3 columns like this. Now there's another way you could present this as well, but I'm going to do this way. Let's see what we got. We're working in Ghana City Million. So here we go. So let's bring the carrying amounts of the items respectively. We have goodwill, we have brand name, we have property, plant, and equipment. So goodwill, brand name, property, plant, and equipment. Then we have current assets, which are stated at their recoverable amounts. So we have 1.4 million, 2, 6, and then 2.4. 1.4, 2, 6, 2.4. And that gave us a total of the carrying amount to be 11.8. Okay, 11.8. Now, sometimes you just want to see if arithmetically they are right in that particular case, because sometimes there can be some typo errors and those things. So let's check whether we are right arithmetically. 1.4 plus 2 plus 6 plus 2.4. Yeah, 11.8. So that is the carrying amount. Stay with me carefully. So we've been given the recoverable amount of the whole business as at the reporting date, which is 9.6 million Ghana City. So the difference between the two will become the amount of the impairment. So 11.8 minus 9.6, it means our impairment is going to be 2.2 in total. Okay, our impairment is 2.2 in total. That's the total impairment. Now, let's see. Do we have any other information? And the impairment of the investment in Manyabe Limited was deemed to be 2.2 million. Okay, it's already there. But again, you have to do the working so that you see. So they've given us the 2.2 million as the impairment figure. And so we see it here. The impairment is coming up at the end of the day, 2.2. Bonito Limited applies IAS 16 property, plant, and equipment and IAS 36 impairment of assets in preparing of its financial statement. That's all we have. That is all we have. So if this is the impairment, 2.2, what is the principle? Go back. We said separately identified impaired asset will be written off. In the context of this question, there was no separately identified impaired asset. They didn't tell us that, oh, there was some asset that has to be written off or something that has to be written off. So what is going to be happening here is that we are going to go to the second step, which is to write off the goodwill. Okay, so we're going to write off the goodwill 1.4. We write the whole thing off. So the recoverable amount is going to be nil. Now remember, they said the recoverable amount of the current asset is the same, so it's not going to be subject to any impairment in that particular case. It's not going to be subject to any impairment. So now, if we write off the goodwill from the 2.2 minus 1.4, what do we have? I get 0.8. So that 0.8 will now be shared between the brand name and the property, plant, and equipment. Okay, so when we add the two up, remember I said allocate the remainder between the other assets on a pro rata basis. So the way we do the allocation on a pro rata basis is to use their carrying amount. So we have 0.8 remaining. So we're going to allocate. So that's going to be, when you add the two, it's going to be 8. So there's no need to work this out, but because I'm in class, let me just do that with you. So the brand name is going to be 2/8 times the 0.8. And then the property, plant, and equipment is going to be 6/8 times 0.8. Are you following? If there are any questions, you put it in the chat for me. So 2 divided by 8 times 0.8, that will be 0.2. So that this place will be 0.6. I don't need a miracle for that at the end of the day. So 0.2 for brand name. So that we'll have 1.8 here. And then 0.6 for this one. So that we'll have 5.4 there. So go back to the context of the question. It says, assuming Menyabe Limited represent a cash generating unit, show the financial reporting treatment of the brand name at 31st December 2021 in the books of Bonito Limited. So after the review, the brand name will be carried at what? 1.8 million. This is the answer to the question. Very sweet, simple, straight to the point for 5 marks. Very sweet, simple, straight to the point. So like I said, the whole 2.2 will be going to P&L. So if I want to have a journal entry, for instance, for this one, again, it's not requiring the question, but I'm in class, so I can be a little bit flexible just to show you. So if we're preparing financial statement, we will debit profit or loss with the entire impairment of 2.2 million. Then we're going to be crediting the things we credited. We are writing off the whole goodwill. So that's why we are writing the whole goodwill of 1.4 off. We are writing off something on the brand name. So we credit the brand name. Then we are writing off something also in the property, plant, and equipment, 0.2 and 0.6. Sounds good? This is the answer to the question. Do this for 5 marks. Very sweet, simple, straight to the point. So that is IAS 36, impairment of assets, and how we do it. So like I said, immediately you read the question, you have to know the principle. Then you have to know how to do the treatment, because if the principle doesn't occur to you, if you don't get a principle, that is where you start chewing your pen. So, sorry, your pen in the exam hall. But you don't want to do that. Okay? You don't want to do that. Okay. All right. So, any questions for me on this one, or everybody good on this one? So, if there are any questions, please bring it up before we go to the next question. I see some of you guys joining. You are welcome. Give us a thumbs up on the video when you join, and also share the link. Okay, share the link. Let's get as many students as possible joining the stream. So let's see if I can bring some comments up. Thailand said, greetings Nhyira, greetings Thailand, thanks for joining us. Forgive me for a little bit darkness on my video. You know, ECG has taken off my lights though, but I'm still good. So just forgive me for the little darkness. Musibo said, well done, sir, from Nigeria. Thank you, Musibo. Then, what else we got? Alfrovi Remedial Mass Academy. Good evening, Nhyira. I'm Gafa from Nigeria. Thank you, Gafa, for joining us. What else we got? George Kepa is giving us an emoji there. Blameless is giving us a thumbs up there. Okay. Then Blameless is having a question. Let's take that quickly. What does it say? It says that, what? Please say, what if the goodwill is having a market value? Goodwill cannot have a market value, Blameless. Okay? Goodwill cannot have a market value. You can't sell goodwill. You cannot sell goodwill. So goodwill doesn't have a market value, cannot have a market value. Okay? It's not it's not a separately identified asset that can be sold. It's not a separately identified asset that can be sold. That is why we will write it off. So it cannot have a market value. All right. Let me know if that is okay for you. Ernestina Quagrin. He's giving us a thumbs up there. Okay. Nathan said, evening, Nhyira. Good evening, Nathan. Thanks for joining us on the stream. Okay, so that's our first question. I hope everybody is good there. Let's move on to our second question. So let's go to the B aspect of the question and see what else we got there. So the B is also for 5 marks. Let's go read the requirements. Now, again, I want you to, you see, not just look at this as, oh, okay, this is how we are solving the question. I want you also pay attention to the way I am discussing the question and the way I'm picking the items up and the conclusions that I'm drawing. And because that's the same thing you're gonna do in the exam hall, and that is very important for you to be able to do that very well. So stay with me carefully. Recommend to the directors of Number Limited on how to account for the above transactions as at 30th June 2022 in accordance with International Financial Reporting Standards. So here, the entity is not having, well, we are not being told of the accounting standard we should apply. The examiner just said in accordance with IFRS, but the year ended is 30th June 2022. That is very important to us. So let's go back up, go read a question, then we can make make a point on the accounting standard that we can apply here. Number Limited is a multinational company with reporting year end 30th June. On 1st July 2021, now stay with me, we are preparing financial statement for 30th June 2022. This is on 1st July 2021. Number acquired a manufacturing machine under an 8-year lease. Oh, okay. So they did the acquisition on 1st July 2021. That is the beginning of the year. And it was a leased asset. Okay. So if it was a leased asset, then we have to apply what? IFRS 16. Yes, IFRS 16 leases in that case, but we don't know the build up. But since it is a lease, then on the low key side, we know that IFRS 16 could apply, but we continue to read. The lease rentals have been recorded correctly. Okay. In the financial statement of Naba Limited. All right. So they've correctly recorded it. Let's see what we have. However, again, once you are reading, there are certain words that opens the door. However means there is a problem. So if they say, oh, the entity has accurately recorded the lease rental, however, that means there is something that is not being done well. So you have to be on the lookout for it. Number Limited could not effectively operate effectively from the unit until alterations to its structure costing 13.2 million were completed. Okay. Now, again, if they did an alteration of 13.2 million Ghana cedi, in accordance with IAS 16, what did we say? We said that the initial cost of an asset shall be the purchaser's cost plus all other directly attributable costs incurred in bringing the asset to its present use. That same rule applies to IFRS 16 lessee accounting. So to get the initial value for the assets that we have leased, it is going to be the present value of the minimum lease payment plus any directly attributable cost that we incur in bringing the asset to its present use. That means the alteration cost of $13.2 million must be included in the initial cost of the machine that they have acquired. Are you getting the idea? That's principle. So once you read a question, the principles must occur. Once you read a question, the principle must occur. It's not about finishing or completing the question before you come and find out, oh, what is the question saying? No. As you are reading, the principles are playing out. So we know that this 13.2 million should be included in the leased asset, in the initial cost of the leased asset. Let's continue. The manufacturing unit was ready for use on 30th June 2022. When is 30th June 2022? The year ended for which we are preparing the financial statement. So let's go. So that was the time the asset became ready for use. The alteration cost 13.2 were charged to administration expenses. Oh, what did we just say? We said the alteration cost must be included in the initial cost of the asset. But what did the company do? They have included it in admin expenses. So if they have included it in admin expenses, what must we do? We must take it from there. We must take it from there. Are you getting the idea? So let's go. Number Limited. Let's begin the story. So Number Limited. Remember the requirement of the question said, recommend to the directors of Number Limited how to account for the above transactions as at 30th June 2022. So as at the end of the year, how should they account for it? So the alteration cost is 13.2 million. It should be included in the initial cost of the asset. So the journal entry is to be debiting property, plant, and equipment. Now, one thing you must understand is this. The verb used there is recommend. Recommend. It means you have to speak English. You have to speak English. The explanation that I've given, you must write it down before you come to the journal entry finally. Are you getting it? So the context of the question suggests that we would have to speak English a little bit. Just a little bit. But we have to speak English anyways. So we debit property, plant, and equipment with the 13.2 million. Then we remove it from the administrative expenses. So we're going to be crediting admin expenses at the end of the day. Give me a sec. My light is back. So we're going to credit admin expenses to remove it from there. Okay, the 13.2 million. But possibly the entity has already finished preparing the financial statement. And so including this 13.2 million in the admin expenses meant that the profit of the year has been reduced by the 13.2 million, which means the retained earnings of the year has also been reduced by that same 13.2 million. So it is either we are crediting admin expenses to remove it from there, or we are crediting the retained earnings so that we go and add back that 13.2 to the retained earnings. So that is the reversal of the mistake they did by not capitalizing the alteration expenses but treating it as a recurrent expenditure. Sounds good? Again, you realize that I've not finished reading the question, but I'm already working out. I'm already getting my solution set up because that's the deal. That's the deal. Let's continue to read. The lease requires Number Limited to restore the unit to its original condition at the end of the lease term. Number Limited estimate that this will cost a further $10 million. Market interest rates are currently at 6%, 7 years time, 8 years time. So you got to be careful here as to what is happening. So if the lease term requires that they will restore the place to how it was, then what accounting standard is coming to town here? IAS 37, provisions, contingent liabilities, and contingent assets. So according to IAS 37, we make provision when it is rotten. So the amounts can be reliably estimated. There is a present obligation which is either legal or constructive. In the context of this question, there is a present obligation as a result of the legal agreement that the entity enters into because it is part of the terms, the conditions of the lease. So there is a present obligation. So since there is a present obligation, it means the entity must provide for this 10 million in the financial statement. And what does IAS 37 says? It says that provision should be included in the initial cost. So we're going to debit property, plant, and equipment with the present value of that future payment discounted at the market rate or the cost of capital of the entity. Then we'll credit what? Provisions, which will be under non-current liabilities. So again, once you read a question, the principal must drop. Once you read a question, the principal must drop. If you read a question, the principal doesn't drop, then you're in a big problem. You're in a big mess. Okay, so let's go. Now, stay with me. The lease term was 8 years. Okay, 8 years. But 1 year had gone. Because currently, we are told that after the alteration, the asset is now ready for use on 30th June 2022. So a year has gone. So under the lease term, we now have 7 years to go. Does that make sense? We now have 7 years to go. Why am I emphasizing on that? It means that the discount factor given to us here, we won't use the 8 years. We will rather use what? The 7 years. So although the lease term is 8 years, the asset had been there for 1 year because of the alteration. So by the time the asset was ready for use, we now have 7 years remaining. So we'll discount this 10 million Ghana cedi into present terms using the 7 years discount factor. So the alteration cost, we've seen the workings. Number 2, provision for restoration. So let's get a provision amount. It's going to be 10 million Ghana cedi times the discount factor is going to be 0.665. So let's get our answer coming up. Okay, now I can punch on my calculator because earlier I wasn't seeing properly. So 10 by 0.665. I'm getting 6.65 million Ghana cedi. So for this 6.65 million Ghana cedi, like we said, it shall be included in the initial cost of the asset because it is not an asset-related provision. Because you know there are two types of provisions. We have asset-related provisions and non-asset-related provision. Non-asset-related provisions will be written off in the P&L account, but asset-related provisions will be included in the initial cost of the asset. So here we're going to debit the property, plant, and equipment. And that is 6.65 million. Then we will credit provisions on the face of the statement of financial position under non-current asset, non-current liabilities rather, with the same figure, 6.65. Any questions? Do this for 5 marks. Very sweet, simple, straight to the point. Do this for 5 marks. We are done. So technically, the PPE figure is going up by 13.2 plus 6.65. And then we'll credit provision. So that is the answer to the question for 5 marks. NABA Limited. But remember the accounting standards being applied here. We are applying IAS 37. There is an element of IFRS 16 so that we can determine the initial amount of the leased asset so that we can know how we do the treatment. Any questions on this one? So this is a 5-mark question that we are supposed to also look at. So I see some of you guys joining. You're welcome. Give us a thumbs up on the video if you're getting some value. And also let me hear from you in the comment section any questions that you have for me. Most importantly, share the video. Let's reach as many students as possible. We are looking at the IFRS Masterclass and we are solving the ICAG July 2023 financial reporting, question 2. We've done the A aspect already, and we just completed with the B aspect of the question. So, any questions for me on this one? Any questions for me on this one? Let's see. Let me know. Okay, Blameless said, sorry, I mean the brand name. Okay, so you're saying that if the brand name had a market value, the recoverable amount is going to be given. So it's not about does it have a market value or not. It's about the recoverable amount. If the recoverable amount of the brand name is given, then that will be used. Just like how we are told that the current assets are at their recoverable amount here, and so the current asset didn't have to suffer impairment. If there is anything, it will be given to us directly. So it's not something that we would have to look out for. So if the recoverable amount is given to us in the question, no P, it means the brand name will not be subject to any impairment. Then in that case, it is the other asset, property, plant, and equipment that will be subject to any situation of impairment for the entity. Okay, let's go to the third question in the discussion. C is an interesting area. It's about government grant, IAS 20. And we've discussed that as well. Remember, for all these IFRSs, you can get the video on the YouTube channel under the IFRS's masterclass on the podcast session of the YouTube channel. And you can get access to all these videos and watch them there. So let's go. Now, this is for 7 marks. So the A was 5, the B was 5, but this one is 7 marks. So, probably the examiner had something under his sleeve. But let's see what we got. Advise. 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 That's the verb the examiner is using here. So again, it means that we're going to tell a little story about that and then find out exactly what we can do. So some theories are going to be coming in, then we will do some calculation, do some journal entries, and then boom, we see what we're going to do at the end of the day. So stay with me. Let's see what we're going to do in that particular case. Advise the management of Pampaso Limited on the accounting treatment of the grant in accordance with IAS 20 government grants and disclosure of government assistance for the year ended 31st December 2021. Like I say always, our year ended is very important to us. So 31st December 2021, Pampaso Limited. So let's go here. Pampaso Limited. So let's go back up and try to read a question. Pampaso Limited is a fruit processing company which is listed on the Ghana Stock Exchange market with a financial year end 31st December. We know that already, we've been told. The trial balance for the year ended 31st December 2022 showed a credit 2021 showed a credit balance of government grant of 1,008. Stay with me. Stay with me. Our year ended is 31st December 2021. The examiner is saying that the trial balance for the year ended 31st December 2021 is showing a credit balance on the government grant at 1,800. Now, before I get excited, if the government grant is showing a credit balance, that means the entity is using the deferred income approach. There are 2 ways to deal with government grant. You can write it off against the initial cost of the asset, or recognize the grant as a deferred income. That means it becomes a liability on the face of the statement of financial position, so that you amortize it annually over the economic useful life of the asset. So with the entity having a credit balance of government grants of 1,800, it tells us that they are using the deferred income approach. Again, if you understand the principles, then you will know the meaning of this. But let's continue to read. As part of the local government initiative to stimulate employment of fresh graduates from tertiary institutions in the locality, Pampaso Limited received a grant of 3 million Ghana cedis towards the purchase of additional production machinery on 1st January 2019. Okay. So stay with me carefully. They received 3 million Ghana cedis on 1st January 2019. Remember, our year ended is 31st December 2021. So if 1st January 2019, that means that 31st December 2019 is 1 year, 31st December 2020 is 2 years. Because currently what is under review is 31st December 2021. 3 years so far. Just want you to understand that. We'll come back to it. The company accordingly acquired additional production machinery costing 3 million on that date. Okay, they've acquired a machinery, but remember the context of the question didn't say how should they account for the above transaction. The question was emphatic. How should they account for the grant? So yes, there is a production machinery that the company has bought, but we don't care about that. Because the question didn't ask us to account for the whole thing. The question said we should account for just the grants part of the question. So context is important so that you don't waste time doing useless workings that won't earn you any mark. The condition attached to the grant was for Pampaso Limited to employ at least 3 fresh graduates every year over the estimated 5 years of the useful life of the asset. Oh, so the economic useful life of the asset is 5 years. That's pretty good. Let's continue. The company, however, since January 2019 has only recruited 1 fresh graduate. The non-compliance of the company in relation to the condition attached to the grant has come to the attention of the local government, and as a result, the company on 1st January 2021 was instructed to repay 50% of the grant received in the next 18 months. Ooh. So, when did they get the notice that they are supposed to make the payment? 1st January 2021. So a couple of things we want to be excited about. You don't do this in the exam hall, but I'm in class, so I'm going to do that with you. So economic useful life of the asset is 5 years. The grant date, it's given to us as 1st January 2019. The grant amount we received was 3 million. Okay. Then the dates that they are supposed to make the repayment is 1st January 2021. So stay with me carefully. So if they are supposed to make the repayment on 1st January 2021, then the question we need to ask ourselves is, as of 1st January 2021, what is the carrying amount of our grant on our books? We'll come back to that. Management, however, has reasonable assurance that the new condition of employing at least 1 fresh graduate a year will be complied with. The company accordingly paid the grant repayable to the local government. Pampaso Limited uses the deferred income method in accounting for grants. You know, we've already identified that, right? So the examiner is generous here to tell you what method they are using. But assuming that last sentence was not stated, you have to understand that by virtue of the fact that the grant is having a credit balance in the trial balance means that they are using the deferred income approach. So we're done. Let's put the pieces together. So they got a grant 2019. The grant must be amortized over 5 years. So 2019 and 2020. So as of 31st December 2020, the question we need to ask ourselves is, what is the carrying amount of the grant? So let's go. So carrying amount of the grant. Tell the examiner we like to work probably 3 zeros up. So we bring in the initial amount, which is at 3,000. Then we're going to less the amortization of grant over the 2 years, which is 2019 and 2020, because the repayment date is on 1st January 2021. So it means we will charge amortization, or we will amortize the grant over 2019 and 2020, 2 years. So we less amortized amount at 31st December 2020. Remember, our initial cost is at 1st January 2019. So that's 2 years over the economic useful life of the asset. So that's 3,000 over 5 years times 2 years. What do we have? That's 1,200. So we get a carrying amount of the grant as at the 31st December 2020. And that is an amount of 1,800. Stay with me. So this is the 31st December 2020. So now they made the payment. So we're going to less the grants that they paid. So we less grant repayment, which is 50% of the grants received. And so that's 50% of the 3,000, and that's 1,500. So when we less that, the grant amount that will be remaining after this so balance of deferred grant after repayment is going to be what? 300. Sorry. It's going to be sorry. It's going to be 300. Are you getting it? It's going to be 300. So now this 300 will now be possibly allocated over the remaining useful life of the asset. So the journal entry for that grant repayment, you know that already. We debit what? The grant, that's why we are subtracting it. Then we credit our cash or bank. So the general entry for the repayment, we debit the government grant. That's why we are lessing it from here in the slide with the 1,500. And then you credit your cash or bank with that same 1,500. Now that 300 left, like I said, is the amount of repayment, because remember the repayment is being done on 1st January 2020, because the government requested that they should do the repayment on 1st January, and as such the company completed the payment. Okay, the company accordingly paid the grants to the local government, so they made a payment to them. So this 300 now will be the amount of grants that will be allocated over the remaining life of the asset, which is 3 years, because we've already done 2 years. So the 300 will now be allocated over what? The remaining economic life of the asset, which is 3 years. So this is the answer to the question. Very sweet, simple, straight to the point. Any questions? Any questions? So this was for 7 marks. Although, I thought there would be a lot of work to be done. I mean, there is not much work to be done in the context of this particular question. As you can see here, we're not doing a lot of work. So any questions on this one? Everybody good? This is IAS 20 government grants, and dealing with the repayment of government grants when there is the entity is using the deferred income approach to account for the government grant. All right, so let's see if I have some questions coming up here. In that case, any questions for me? Okay, sir. Thanks very much. Okay, so that's from Blameless. Samuel said, I'm late. Oh, Samuel from Break Room. Okay, don't worry. The playback will be available after the stream on YouTube, so you can watch the playback. We've been trying to solve some questions, so you can watch the playback after the lecture, definitely. I think this is Samuel chapter 1, I guess. All right, let's go. Nathan said, supposing the amount payable is more than the remaining balance of the grant, please explain the treatment, sir. Okay, so that means the balancing figure will be going to the bank statement. Okay, so let me bring back my slide. So what Nathan is asking is, in this case, we had 1,008 remaining, right? And we're supposed to pay 1,005. So Nathan is saying that assuming we are paying more than what we have available, the balancing figure will just go to the cash book. So just let's say we are paying whatever the heck. How much should we pay? Let's say we are paying all the grants, not 50%. So we are paying all the grants. All right, so repayment of the full amount. So if you are repaying the full amount, what do? We credit our cash book with a full amount, which is the 3,000, the whole 3,000. Okay, but then we're going to debit the government's grant account with how much is available as at the date that the repayment became due. In our question here, it's 1,800. Okay, so the balancing figure will be debited to the P&L account as an expenses for the year. So the balancing figure will go to profit or loss, and it'll be part of general expenses, or it could be a line item on the face of the statement of financial performance or statement of profit or loss, and that's going to be 1,200, I guess. Sounds good? So that's what happens. If the amount we are repaying exceeds the amount of the grant outstanding, the balancing figure is treated as an expenses in the P&L account. So Nathan, that is how we would have done the treatment in that case for us to get the issue in that regard. So let me know if you are clear with that one. So that was from Nathan. Next one. Tylon said, thank you, Nhyira. You are making my life easy here in Zimbabwe. Great to hear that I'm making your life easy for you. We thank God. And thanks for joining us on the stream, Tylon. What else do we have? At this point, my mouse is misbehaving. Okay, okay. So Samuel chapter 1 are here. Nathan said, thank you, sir. All right, that's fine. Any other questions on this question? Any other questions on this question? Let me bring back my slide here. Okay, so that was 7 marks. So I don't know if you can see what I'm seeing and smell what I'm smelling, though. But you realize that it's not difficult to look at the questions we are seeing. It's not difficult. But this is the part of the discussion where somebody said, oh, Nhyira, you know, when you're solving the question with us, it looks like you know everything. But you see, when I pick the question myself, I can't see to understand. Yes, because you are refusing to understand the principles that underlie the accounting standards. So before we talk about anything as to the fact that when you pick the question, you can solve or you can apply the accounting standards, we need to go back and ask you, do you understand the basic principles? Because if you pay attention carefully, realize that these are Fala questions. Me and son 2000. Me mamia bokai. Me mamia bokai. It's like the examiner was doing don't call me for you. These are don't call me questions. You don't need a miracle for don't call me questions. Okay, let's take the last one, the D aspect of the question, and that's for 3 marks. And this was what I keep on telling you Financial reporting student, you have a dedicated 20-mark question on accounting standards. Corporate reporting student, you have a dedicated 25-mark question on the accounting standards. Dedicated. So now, before the single entity will come in, because for the single entity, the question 3, everything there is actually an accounting standard. And we'll get into that also some other time. Because from now till you write the exam, we're going to be trying to solve these questions so that you see how these things apply generally. So let's get the D aspect of the question. And that is on IAS 37, provisions, contingent liabilities, contingent asset. Now remember, we previously applied the principle under the question B, which is NABA Limited, because we use the IAS 37 rule to discount and treat the restoration cost of the leased factory or building that the entity had leased. So let's see what we got. The objective of IAS 37 provisions, contingent liabilities, and contingent assets is to ensure that appropriate recognition criteria and measurement bases are applied to provisions, contingent liabilities, and contingent assets, and that sufficient information is disclosed in the notes to the financial statement to enable users to understand their nature, timing, and amount. Look at the plenty story the examiner is telling you. Then he says, explain contingent liability and contingent assets as used in the above statement. So it's just a one-liner definition that the examiner is telling you. This is a very simple issue. Contingent liabilities, or contingent liability is a possible, obligation as a result of past events, whose existence will be confirmed either by the occurrence or non-occurrence of some other future events which are outside the control of the entity. So possible liability, okay, or possible obligation. That is a contingent liability. Contingent asset is possible asset whose existence will be confirmed by the occurrence or non-occurrence of some future event which is outside the control of the entity. That's all. Write that and get 3 marks. What else do you want? Like I said, it was a don't call me exam. Don't call me questions. My mother has lost, oh, my mother is coming, oh, my mother is coming, oh, please help me, oh. That was what the examiner was doing for you. So that is the answer to the question, and that is the question 2, and what you were supposed to do in that case. It's a 20-mark question. Technically, it means you need 36 minutes to be able to work this out. We're done. We're done. So in this question 2, we are seeing that there is IAS 37. We are seeing there is IAS 36. We are seeing that there is IAS 20. We are even applying the spirit of IFRS 16 leases in the question. And all these are coming in for 20 marks. There is an IAS 16 even in the mix as well in that case. So 1, 2, 3, 4, 5 accounting standards for 20 marks. Then you come to the question 3. Definitely we're going to be solving this later on. If there are any questions, you can put it in the chat for me. Any follow-up questions in respect of these standards. In question 3, each of the footnotes is, an accounting standard that you need to know about generally at the end of the day. And we'll get into that later on. All right? So this is the issue, and these are the things that you need to understand in respect of these accounting standards. So again, you remember that I said this and I keep on saying it. It's about understanding the principles underlining the accounting standards. And so when you understand the principles underlining the accounting standards, then immediately you read the question, the principle will occur to you. That, okay, this is what is happening, this is what I'm supposed to do, this is how I'm supposed to recognize this. But then if you read a question and nothing happens into your mind, then you're going to be in a lot of trouble in that particular case. So that is very important. Seeing a question coming up from Elizabeth, said, Nhyira, please, will the executive master class you will be starting this Saturday be shared on YouTube. No, our executive revision masterclass are exclusive for our students who have enrolled in our full courses. We don't do intervention, so it's going to be exclusive to our students in that case. So the students who have made, you know, studying under my mentorship with us here, they are going to be getting that exclusive thing in that regard. We will see if we will be having more times like this to be able to answer more of the questions generally in that particular case. But our executive revision masterclass is not going to be available, unfortunately, on YouTube. Elizabeth, it's exclusive for our students. You're going to be solving questions, assisting students with their problems, their challenges, and all that. So it's going to be exclusive, unfortunately. All right. And in case you are thinking about, like I said, thinking about joining our executive revision masterclass, it's pretty simple. Like I said, because we don't open it to the public, it means that you would have to enroll in a course and then get access to join our programs generally. So if you are interested, you can send us a message on WhatsApp 0501149296. 0501149296. So you can send us a message on WhatsApp. We'll be able to direct you on what to do, because your enrollment will give you access to the catalog of all the videos that we have covered throughout this semester and last semester. Then you'll be able to join our executive revision masterclass as well, do our mock session, and be guided properly so you'll be able to pass the examination. So the only way you can be part of our executive revision masterclass is to enroll in our full course at the end of the day, because we don't do intervention. It's something we don't believe in, so we don't do it. We rather spend that time with our students, and it helps us also so that we don't bring outsiders who are not familiar with our system, who have not been part of the process all this while, because it helps us to spend time with our students, and then because we know them. For the last 9 weeks, I know Samuel chapter 1, I know Nathan, I know their problems. So during the revision, that is where we can take time to deliver them very well, generally in that particular case, so they can go in there and pass the examination. That is why we don't do any intervention and bring in outsiders. But if it is something you want to be part, then you have to be part of our entire program. Hence, you have to enroll in our full course on our website in that case. Okay? So that's it about that. All right. So I'm going to be wrapping up around here today, and God willing, Monday, I'm going to be coming your way as we look at it. Like I said, from now on, all we're going to be doing is solving questions in various subjects. So it's not going to just be financial reporting and corporate reporting. So we're going to try to spread our wings a little bit into strategic case study, into advanced audit and assurance, into public sector accounting and finance, into financial management. So we're going to be spreading our wings a lot. So let's see how that is going to go. Just solving questions. And the beauty of that is that as I'm solving the questions, I'm also throwing light on the principles, and that will help you to really position yourself to pass the examination. So thank you very much, guys, for joining the stream today. And thank you guys for the thumbs up and the sharing. If you have not subscribed to the channel, make sure you subscribe to the channel and stay connected. We're going to be releasing some content tomorrow and then on Sunday on the channel. I'm not sure what kind of content it will be, but it's going to be something that relates to your exam. So make sure you are subscribed, stay connected, and when the video go live, you'll be able to watch it tomorrow at maybe 4:30, and Sunday also the same time, so that you can really prepare well. Like I said, on Wednesday, we have about 5 weeks to go. If you really want to pass the November 2023 examination, you have a lot of time, and you can do a lot of damages if you really put in the work and put in the effort in the next 5 weeks. All right? So Have a great weekend. Thanks for joining us. And we will return on Monday at 4:30 p.m. or 16:30 GMT as we continue with our discussion for the November 2023 examination. Stay safe and take care of yourself. Bye bye.